I thought the stock market was just a numbers game. You look at a company's profits, its growth, its debt, and if the numbers add up, you invest. It all seems so rational, so logical. For years, that's how I approached it. I'd spend hours buried in financial statements and analyst reports, convinced I could outsmart the market by just being more diligent than the next person. When I first started investing in my late 20s, I was all about the fundamentals. I'd find a company that looked solid on paper, good revenue, low debt, a strong balance sheet. I'd put my money in and wait. Sometimes it worked. I'd get a nice little bump, feel like a genius, and cash out. But other times, it was baffling. A company with perfect financials would just drift sideways for months, or even drop. And then I'd see some other stock, one with messy finances or a questionable business model, suddenly skyrocket. It made no sense to me. I was following all the rules I'd read in books, but the market seemed to be playing a different game entirely. The accumulated consequences of this approach were mixed. I didn't lose my shirt, but I didn't exactly build significant wealth either. My portfolio was a patchwork of small wins and frustrating plateaus. I was making a bit of money, but I was also leaving a lot on the table. The biggest cost, though, wasn't financial. It was the mental energy I was expending. I felt like I was constantly fighting the market, trying to force my logic onto something that felt chaotic and unpredictable. I was always on edge, checking prices, rereading reports, and wondering what I was missing. It was exhausting. The turning point came not from a book or a financial guru, but from an old interview I stumbled upon with George Soros. He wasn't talking about P/E ratios or earnings per share. He was talking about something he called reflexivity. The idea, as I understood it, was that investors don't just react to the reality of a company, their actions and beliefs actually shape that reality. When enough people believe a stock is going to go up, they buy it, which drives the price up, which then validates their belief and encourages even more people to buy. It's a feedback loop. The market wasn't a cold, calculating machine. It was a swirling mass of human psychology, fear, greed, hope, and panic. Suddenly, everything clicked into place. I realized I had been focusing only on the what a company's value was. But the top investors, they were also focusing on the who and the why, who is buying and selling, and why were they doing it. They weren't just analyzing spreadsheets, they were analyzing sentiment. They understood that a stock's price isn't just a reflection of its intrinsic value, but a reflection of the collective mood of the market. And that mood could be swayed by a news story, a tweet, a rumor, anything. Looking back, what I can't reclaim is all that time I spent thinking I was smarter than the crowd. I was so focused on being a contrarian based on numbers that I missed the bigger picture. Sometimes the crowd itself is the signal. I missed out on massive trends, both up and down, because they didn't fit my rigid, logical framework. I saw the dot-com bubble inflate, and I stood on the sidelines scoffing at the ridiculous valuations, which was right in the end, but I also missed the legitimate innovators that emerged from that era. I saw the rise of social media and thought it was a fad. I was so busy looking at the balance sheets that I failed to see the cultural shift happening right in front of me. The opportunity cost wasn't just in dollars. It was in understanding how the modern world works. So, here's what I wish I knew when I was 25. The market has two parts, the fundamentals and the story. The fundamentals tell you what a company is worth in a vacuum. The story, or the market psychology, tells you what people are willing to pay for it right now. And often, the story is far more powerful in the short to medium term. Learning to detect opportunity isn't just about finding undervalued companies. It's about understanding the narrative that's driving the market. Ask yourself, what is the dominant story right now? Is it fear about a recession? Is it excitement about a new technology like AI? Is it greed driving a meme stock? When you see a stock moving, don't just ask if the price is justified by the numbers. Ask why people are buying or selling. What are they afraid of? What are they hoping for? You start to see patterns. You see how a bad earnings report for one company can create a wave of panic that pulls down an entire sector, creating buying opportunities in perfectly good companies that got caught in the crossfire. You see how a positive news cycle can create a halo effect, lifting stocks that are only tangentially related to the good news. It's about learning to read the room. Top investors don't just have an edge in information, they have an edge in interpreting human behavior. They understand that when everyone is terrified, that's often the moment of maximum opportunity. And when everyone is euphoric and convinced they can't lose, that's the moment of maximum risk. They're not just reacting to the price action, they're anticipating it by understanding the emotions that fuel it. At 40, my investing strategy is completely different. I still look at the fundamentals as your anchor, your margin of safety. But now I spend just as much time trying to understand the psychology. I read forums, I watch social media trends, I pay attention to the news headlines, not just for the information, but for the tone. Is it sensational? Is it fear-mongering? Is it overly optimistic? Because that tone is what shapes the beliefs of millions of investors, and those beliefs are what will move the market tomorrow. It's not about predicting the future. It's about understanding the present state of the collective mind. And in that understanding, you can find opportunities long before they show up on any spreadsheet. Thanks for listening.